Good morning, every of you, because since the global situation, we have stopped our learning at mid of March. However, we cannot stop our learning. We cannot stop our studies. We have to continue it. Fortunately or unfortunately, exam was extended without exact date. However, we have to accept that exam can be held on May or June after the reschedulement. However, up to now, we have to continue our studies. Therefore, CS Sri Lanka decided to discuss additional revision program, carry out additional revision program based on the model papers already published in the CS Sri Lanka website. For business level 1 and 2 exams, you have 8 subjects. Business level 1, 4 subjects, and business level 2, 4 subjects you have. All for these 8 subjects, CS Sri Lanka already published their mock exam pilot papers, including the answers. From today, we are going to discuss those pilot papers with the answers for each subject. Today, we are going to start with BL6 Management Accounting paper. Right? Today is the first session. We are expecting to have 6-hour sessions to discuss all the 50 questions with the answers. Especially here we are going to focus not only the answer of each questions, we are trying to discuss the related theoretical matters and how that question can be tested in another way than the question presented in the paper. Right. Let's start the session, the discussion of pilot papers for BL subjects from today. Moving into the question paper. First of all, I will explain how the exam going to be processed. You have 2 hours. It is clearly mentioned in the pilot paper also. Keep your mind, this is not a 3-hour paper. Our practice was for last exam. Each exam we had 3 hours, but in this time for business level papers, we have only 2 hours. That is very important. You have to read your instruction at the exam also. This is a 2-hour paper with 100 marks. Basically, all business level 8 subjects consist MCQ questions. You don't need to write any answer. You have to select the answer out of the given 4 answers or 5 answers. That's why those are MCQ questions. That is the next important point. You have only 2 hours. You have 50 questions. All 50 questions, you have 4 answers or 5 answers. You have to select the correct answer. However, to select the correct answer, you need to carry out your own calculation. Right? That's a very important point. You need to do some calculations. You need to some preparations of some technical matters. For an example, you have to prepare process accounts. You have to prepare job costing accounts. You have to prepare variance calculations. Based on your calculation, you have to select the answer on the paper, right? However, very important point, you need to keep your mind, you have only 2 hours to answer 50 MCQ questions, right? This is the BL6 Management Accounting pilot paper. Here also you have 50 questions. Today we are going to discuss all the theoretical matters around these each questions, right? Let's start with the first question now. I think you already referred the revision program we already carried out on this subject. In that revision program also we have discussed some possible multiple choice questions, right? Possible multiple choice questions I have selected from ACCA and CA different professional level exams, and I have discussed with you. If you not referred yet, please download those videos. It is already available in the CS Sri Lanka webinar YouTube channel as well as CS Sri Lanka website under the webinar, right? This exam focus seminar series under the website you can download, as well as you can refer the CS Sri Lanka webinar YouTube channel. All videos already available. We completed 9 to 10 videos covering the all theoretical areas related to the management accounting. If you not referred it, please refer those videos also before watch this pilot paper video. Once you refer that videos and this pilot paper video, I can assure you can have enough knowledge to sit this exam. Okay, let's start with the first questions, right? The first question basically focused on the identification or separation the management accounting with other accounting aspects. Basically, we are practicing financial accounting for the purpose of presenting financial statement. In addition to that, we have this management accounting subject. Now, this question trying to separate management accounting and financial accounting. The question is, which of the following statement correctly describe the difference between management accounting and financial accounting? You can see the answer also highlighted, right? Each and every paper answer highlighted the way of bold in the papers, right? The sentences. Now here answer is C, but without going to the answer directly, let's see how the financial accounting and management accounting can be bifurcated. You know, financial accounting, their purpose is to provide economic information of the entity to the users, especially prospective and the current investors, lenders and creditors. That is the basic identification under the conceptual framework. Therefore, financial accounting focus to provide economic information to the users, especially its focus, their fast financial information. Once they completed the financial year, for that financial year, they will provide their P&L statement of financial position, that is balance sheet and other elements of the financial statements, especially focusing on historical data. But when it's come to the management accounting, management, their main objective is to take decisions for the going concern of the business, for the increase of their profit and wealth, right? Therefore, management accountants need to take decisions go forward. They have to use both past and future data. That is the basic difference. Especially management accounting referred by management at the top level of the organization, but financial accounting referring by all the users, including investors, lenders and creditors. Therefore, let's see the first answer, why it cannot be selected as the answer. Financial accounting provides information to external users, while management accounting provides information to internal users. It is incorrect. The reason is management accounting provides information for the internal users. That is correct. Management accounting reports not going to publish. Therefore, it is provide for internal users. But financial accounting not only for external users, it is providing to the prospectus users. Prospectus users may not be the external. Internal users also using financial accounts. For an example, the top management, CEO, finance director, other directors, other managers also use financial accounts in addition to the external users. Therefore, answer A cannot be accepted. B, financial accounting provide information to internal users, while management accounting provide information to external users. Again, it cannot be accepted. Why? Financial accounting provide information for both external and internal users. Management accounting provide information only for internal users. Answer C is the answer. Before moving to the C, let's see D. Why D cannot be accepted as the answer? Both financial accounting and management accounting provide information to internal users. It cannot be accepted. You know, financial accounting provide information about the history, past financial year, both internal and external users. Management accounting provide both past and future information to internal users. Therefore, answer is C. C explained like this. Financial accounting provide information to external and internal users, while management accounting provide information to internal users only. Now you understood, I think you understood why we have to understand the difference between management accounting and financial accounting is clear. That's why that question taken as the number 1 question, since our subject also the management accounting. Let's move into the question number 2. Question number 2 is a questions about the cost behavior. I will explain basically what is the cost behavior, how cost behave within the organization. You know, some cost of the organization changing according to the volume. When you increasing your production, the cost increasing according to the increasing of production. That is, some costs are increasing according to the increasing of the quantity and vice versa. As well as some costs that company incur, it never change according to the quantity you produce. However, only within the capacity. I will give you an example. We have discussed this matter under the seminar series also. Let's take a simple example. A bakery producing breads, right? A bakery, assume that a bakery running on a rented building, they have to pay 10,000 rupees a rental per month, even they produce bread or not. 0 breads, 100 breads or 1000 breads, they have to pay their rental 10,000. That means that 10,000 will not change according to the quantity. That type of cost we call fixed cost. However, wheat flour, yeast and other material, sometimes direct labor involving in the production of breads will change according to the quantity increase. For 1 bread, the quantity of wheat flour and other material will be changed when you produce in 2 breads. Again, it will be changed when you produce in 3 breads. Those called variable cost. But you need to keep very important point in your mind. What is it? Fixed cost will remain constant only within the capacity. That is, assume that bakery can sell maximum 1000 breads per month using that building, right? Company can produce and sell maximum 1000 breads per month using that building. Why? That building capacity only facilitate to produce and sell 1000 breads. Therefore, the rental will remain at 10,000 as I told you within the first 1000 breads. If you need to increase your number of breads you can sell per month, that means if you need to increase your capacity, your ability, you need to rent out another building. In such a case, your fixed cost will increase. Therefore, you need to keep fixed cost will remain constant within the capacity, right? Fixed cost also will change if you increase the capacity. Let's see the question now. Within the relevant range, what is this within the relevant range? This wording is very important. Within the relevant range, that is within the capacity, right? Within the capacity, the total amount of a blank cost change in direct proportion to the change in the cost driver. What is this cost driver? The unit, the smallest unit we will consider to measure the cost. Here, cost driver in a manufacturing company may be the unit you produce. In my example, the bakery, the cost driver will be the bread you produce, right? Therefore, when the cost driver changing within the relevant change, the amount of cost will change, that is variable cost. Therefore, answer for this blank should be variable cost. Then within the relevant range, that is within the capacity, right? Within the capacity, the total amount of specific cost does not change in direct proportions to the change in the cost driver. When the number of units change within the capacity, a cost not be changed, that is called fixed cost. Therefore, answer would be the first blank variable cost and second blank it would be fixed cost. That's why answer selected as B. This is the answer, variable and fixed cost, right? Moving into the question number 3 and 4. Both question number 3 and 4, they have been given a table. That table consists output level and total cost. Output level and respective total cost values of a manufacturer are as follows. We have been given 6 set of information regarding 6 output levels and their respective total cost. Let's see the question 3 and 4. What they ask about the question 3 and 4. The cost include step cost. Step cost means, what is step cost? I think you can remember we have discussed in our first video relating to this subject seminar series. Step cost means cost will remain at a fixed value up to a specific number of units. Thereafter, it will increase. Again, it will remain at the increased level up to a specific number of units, and thereafter it will increase again. That's called step cost, right? I think you can remember the pictorial presentation also of the step cost. It will remain constant up to a specific quantity, then increase, again remain constant up to a specific quantity, again increase. That's why it's called step. The graph of that step cost can be present as a staircase. That's why it's called step cost, right? Now here they have mentioned the total cost include a step fixed cost component which will increase after 4,500 units. That is the important point. After 4,500 units. That means that step cost not applicable for 4,500 units, because it mentioned that it will increase after 4,500 units. That means including 4,500 there is no step fixed cost, but after that, that is from 4,501 unit, that step cost will be applicable. Therefore, up to this point you don't have step cost, right? Thereafter, that means in these two scenario you have the step costs. Clear? The first question number 3. What is the variable cost per unit? Question number 4. What is the change in fixed cost after 4,500? That's called what is the step cost. 2 questions you have. You know, one, you received the quantity and the total cost. To find variable cost, fixed cost and step cost, you have to use a specific technique called high-low method. You know what is high-low method? You find lowest quantity and highest quantity, or you will find 2 quantity levels and their respective fixed cost. Considering their changes, that is change in the total cost and change in the output level, you are trying to find out the variable cost. That is the high-low method. Let's calculate this now using an Excel sheet. We know, let's copy these figures. I think you can do this using your calculators. Let's try here. We have 6 information. Right, these are the information given. Now, very important point, they have mentioned there is a step cost after 4,500 units. That means step cost in between this point 4,500 and 5,000 200. Therefore, to find the variable cost, it is better to take two quantities within this range or this range. Clear? Don't take quantity 4500 and 5200 in order to find out the variable cost. Why? In high-low method, we assume when quantity here increase by 400, if you take these two set, here when quantity increase by 400, cost was increased by 2000. Is that clear? Now this is the total cost, this is the quantity, right? Now if you select these two sets, you can see the quantity was increased by 400 units, as well as cost was increased by 2000, right? Now if you use what is the increase per unit, the delta TZ 2000, delta Q 400. Therefore, we can say per unit it is increased by 5 rupees. It is increased by 5 rupees, right? Now, this is the variable cost. Why I am telling not to take these two sets of accounts? Why? Question clearly mentioned after 4500, that means in between these two, there is a step cost, that is fixed cost has been increased by additional value. Therefore, difference between 34,500 and 44,000, the difference not only the variable cost, that difference reflect the step cost also in between these two. Therefore, when you receive information for high-low method, don't take two quantity level before the step cost and after the step cost to find out the variable cost. Therefore, better to select two sets from this range or two sets from this range to find out the variable cost. Now, here we have selected these two sets to find out the variable cost. Delta total cost, the difference of the total cost divided by difference of the quantity, 2000 divided by 400, it is 5. Therefore, variable cost per unit would be 5 rupees. You can see the answer A, right? Now, second question, question number 4, raise about what is the fixed cost after 4,000, what is the change in fixed cost? The change in fixed cost after 4,500, what is it? They are asking what would be the step cost after 4,500, that is by how much fixed cost will increase, by how much fixed cost will increase, that is the answer they are expecting. Now, they clearly mention when the quantity increase from 4,500 to 5,200, right? When quantity increasing from 4,500 to 5,200, there is a step cost. Therefore, this difference not always reflect the variable cost, including the step cost. Therefore, let us calculate step cost like this. If I take this column as total variable cost, right, I will select, no need to calculate for both, we can calculate because we need to find out the step cost in between these two, because after 4,500 they are incurring step cost. Therefore, I will select these two set of information. If I calculate here the total variable cost, that will be 4,500 into 5 rupees, that is the variable cost. If I take this, the total variable cost will be 5200 into 5 rupees. Right, this is the total variable cost. Now I can take total fixed cost, that is total cost minus total variable cost. Therefore, total fixed cost will be this minus total variable cost. This is the total fixed cost. When it's come to this level, total fixed cost will be total cost minus total variable cost, that is 18,000. Now we know generally the fixed cost need to be constant at each quantity level, but after 4,500 there is a step cost. That's why you can see there is a difference in the two quantity level relating to the fixed cost. That difference is the step cost. That difference shows in between these two. You can see the difference. That difference is 6,000, right? The difference shows 6,000. Therefore, step cost would be 6,000. Very important point. If examiner asks you to calculate variable cost, select two set of data within one range out of two range. Here I have here colored this by, let's this colored by green, right. This is the green range, this is the yellow range. Within green range no step cost, within this yellow range no step cost. But from 4,000 to 5,000, 4,500 to 5,200 there is a step cost. That is the question mentioned. Therefore, when calculate variable cost, you have to use two set of data from here or two set of data from here. Don't select like this to calculate the variable cost, since in between these two you have step cost. Is that clear? Point number one you need to keep your mind. Then to calculate this step cost, definitely you have to select these 2 points. First calculate the variable cost, then take the total fixed cost. The difference between the total fixed cost in the two quantity level will be the step cost. Therefore, our answer would be for the question number 4 is 6,000. This is the answer. They also mention as 6,000. I think you understood how to find out the step cost. I will repeat it again. To calculate variable cost, you have to first divide into the two set of data, identifying the point you have the step cost. This is the point you have step cost. Therefore, you colored this range and this range separately. Then to calculate variable cost, you need to select two set of data from this range or two set of data from this range. Thereafter, to calculate step cost, you need to select these two set definitely. Otherwise, you cannot find out step cost, since step cost include between these two. Is that clear? Right. Now let's move into the question number 5. Now they clearly mention to answer question number 6 and 7, we have to use this description. Right. Let's take this description. The job of 10 units require 25 kilograms of raw material at cost of 20.5. 10 labor hours at cost of 160 rupees per hour. Direct other expenses 450 rupees. Company operates in a rented building and rent per month 20,000 and monthly budgeted production 10,000 units. Now this budgeted production, monthly budgeted production 10,000, it is very important for us. Why? This budgeted production says what is our capacity. This is our capacity. This budgeted production says as the capacity. Our capacity is 1000 units. Is that clear? Since our capacity is 1000 units, all fixed cost, right? All fixed cost need to be absorbed using the capacity. Since our rent is a fixed cost, capacity is 1000, right? We can calculate our fixed cost per unit by dividing 20,000 by 1000. Therefore, fixed cost per unit will be 20 rupees, right? This is the fixed cost per unit. Why? When you have the fixed cost, that should be divided by capacity to find out fixed cost per unit. In a variable cost, they have given clearly what is the variable cost per unit. Here, per 1 unit, for 10 units, 25 kilograms of raw material, 10 hours of labor, and direct other cost 450. That is direct cost, variable cost. This part says you the fixed cost. Okay. What is the prime cost? Prime cost means the direct cost, or in other words, variable cost. You have to take direct material. What is the prime cost of the job? You need to calculate direct material of 10 units, direct labor of 10 units, and direct other expenses of 10 units. Let's calculate using this information, right? From this point to this point, you have explained the variable cost information. Let's take into Excel sheet. These are the information provided in the question, right? Now what we have to do, we have to calculate direct material cost. The direct material cost will be for 10 units, you need 25 kilograms at a cost of 20.5. Therefore, 25 kilograms into 20.5. Then direct labor, you know, we require 10 hours at 160 rupees per hour, and direct other cost, totally they have given it as 450. Let's see the values here. This is equal 25 into 20.5, here 10 into 160, that is 1600, and here 450. All together, let's take the total 6562.5 is the prime cost. What is prime cost? Prime cost actually consists the direct cost, direct material, direct labor, and direct other. These three called prime cost. As well as you have indirect material, indirect labor, and indirect other cost. Those indirect cost called overhead. Direct cost called prime cost. You can remember this technique. We are using this technique in the preparation of manufacturing accounts, also in financial accounting. Therefore, the prime cost will be 2562.5. 2562.5 is the answer. Now, let's moving into the question number 7. What is the total cost to complete the job? To complete the job, you need to incur total prime cost plus part of your fixed cost. This entire rental, 20,000 units, as I explained, will incur for 1000 units. Why? The fixed cost will be incurred for the capacity, as I told you early. Fixed cost will be incurred for the capacity. Now your capacity is 1000 units. You can see here, I have calculated this, right? Capacity is 10,000 units. The total fixed cost is 20,000. Therefore, 20,000 will be divided by the capacity to find out fixed cost per unit. In your job, you are producing only 10 units. Therefore, your fixed cost in your job will be 20 into 10, that is 200. If we take that here, let's take absorb, right? Absorbed fixed cost will be 20 rupees into 10 units, because your job consists only 10 units. That will be 200. Therefore, total cost will be 2762.5. This will be the total cost of the job, 2762.5. Let's see the answer. Question number 7. 2762.5. Very important point to learn. Direct cost will be taken directly to the number of units you are going to produce, which is 10 units, but fixed cost need to be considered by dividing total fixed cost by the capacity, that is 1000 units. That's how we have calculated fixed cost per unit. Thereafter, we have multiplied this 20 by 10 since our job consists 10 units. I think you got the idea. Try to keep not only this answer in your mind, how we have reached the answer. It is very important when you are answering this type of question. Now, we will move into the question number 8. Right, our question number 8 actually about sales variances, right? Therefore, first of all, you must know how to calculate sales variances. Therefore, I will bring you to our study text, right? In the study text, we have a separate lesson for variance. Let's take the lesson first. Chapter 10, page number 279. Right. Under the chapter 10, the subtopic 10 under the chapter 10 is the sales variance. I think you have the study text with you. Here they have mentioned sales price variances is measure of the effect of expected contribution of a different selling price to the standard selling price. Now, let's see what are the variances we have to calculate, right? Here this example for the total variances, that is selling price variance and sales volume contribution variance. That means in sale variances, basically we have to calculate two variances. These two variances are selling price variance and sales volume contribution variance. if you take this example, that is sales price variance, that is trying to find out the variance of the expected selling price and actual selling price on actual quantity you sold, right? See this example. Suppose that the standard selling price 1500, actual sales were 2000 units at 1530 per unit. The selling price variance, very important to understand the variance. The variance is selling price variance. Here they are asking selling price variance. Selling price. Now, to calculate selling price variance, you need to take actual price and standard price, right? Here they have mentioned the actual price was, in this example, 1530, but the standard price was 1500. Now see what happened? They expected to sell the unit at 1500, but they sold it at 1530. That means they have earned 30 additional rupees per unit. Is that clear? They have earned 30 additional rupees per unit. Is it a favorable or adverse? Actually, this is a favorable thing. Why? This is sales. When the sales perspective, when actual increase more than expected, that is good. Even sales price or quantity, when the actual increase is more than expected, it is good because it is revenue, right? Now here they were expected to sell it at 1500, but they actually sold it at 1530. They have additional 30 rupees earned. How much the total earning? They actually sold 2000 units. Therefore, they were able to earn additional 30 rupees. See this additional 30 rupees on actual 2000 units. Therefore, answer would be 60,000 rupees. That is favorable for you. That's why you have answer here favorable, right? Now you know how to calculate selling price variance. This is selling price variance. How we can calculate? Take actual price, take standard price, see the difference of the price. That increase is a favorable, decrease is an adverse effect. Multiplied by the actual quantity, you can have the price variance, sales price variance, that focus on the change in the price. Then let's see the sales volume contribution variance. When it's come to sales volume contribution variance, this is trying to focus how the actual quantity. Now in the previous variance, we focused to calculate the price change. Now here we are going to focus to calculate, we are going to calculate the quantity variance. Is that clear? This is very easy to keep your mind, right? I will give you that hint after completion of this part. This variance analysis is very easy to keep in your mind. That hint I will give you later on. Now let's see the second variance of the sales. Sales volume. Look at the wording. Sales volume. Here we are going to focus the quantity. The previous is the price. Now we are going to focus on the quantity, right? However, that quantity variance need to be multiplied by the contribution. That's why they ask you to calculate sales volume contribution variance. If I explain this in detail, you need to take, I told you, when actual increase more than the budgeted or expected, right, that is good, since this is revenue, right? You have to take actual quantity, then you can minus standard quantity from that. This difference shows you the quantity you sold more than the expected or less than the expected. Then sales volume contribution variance. Therefore, here this need to be multiplied by contribution. Which contribution? In the sales price variance, we considered the actual price. Therefore, when you get in the contribution, you cannot take again the actual contribution. Therefore, you have to calculate here not the actual contribution, standard contribution. That is the way. Take actual quantity and standard quantity and see the difference of the quantity, then multiply it by standard contribution. Now let's see the figures here. The budgeted, the expected quantity 8,000 units of product J. The expected price 1,200 per unit. The full standard cost per unit 700. Why this expected selling price and standard cost per unit given? The reason is to find out the contribution per unit. The standard contribution per unit is 1,200 minus 700. Therefore, standard contribution here we can take standard contribution as, right, 1,200 minus 700, that is 500. Now we need to take what is actual quantity and what is standard quantity in order to calculate the variance. In this case, the standard quantity given as 8,000 units, but actually they have sold 7,700 units, right? Therefore, the actual quantity 7,700 units, but standard quantity 8,000 units. Now you can see you have sold 3,000 units less than you expected. Therefore, it is an adverse variance because it is a loss for you. You not sold what you expected. It is less 300. Therefore, 300 into 500. 300 into 500. Here you have a minus answer 300 because it is a loss. 300 into 500, 15,000. Therefore, your loss is 15,000. Adverse variance 15,000. Based on this knowledge, now we can summarize the sales variance, right? The computation of sale variance I will explain using a separate sheet. If examiner asks you to calculate sales variance, right, this can be divided into sale price variance and see the word sales price variance and sale volume contribution. That means they are asking you to multiply it by contribution variance, right? Now let's try to develop the formula here. Sales price variance, the variance of the price. Therefore, we will take here actual price minus standard price into actual quantity. That was the formula we used. When it's come to sales volume, you need to take the volume variance. Therefore, actual quantity minus standard quantity into standard contribution. Those are the two formula. Now let's see the question. Right? Question asks If the company could sell 4,800 units, actual sale 4,800 unit in the above mentioned month, what is the sales volume contribution variance? The question sales volume, that is they ask in sales volume. Let's apply information here. We need actual quantity, we need a standard quantity and standard contribution. Actual quantity, they already mentioned actual quantity is 4,800 minus standard quantity. They budgeted to sell 5,000 units. Now you can see they made a loss of 200 units because they expected to sold 5,000 but they actually sold only 4,800. Therefore, there is a loss of 200 units. Now you need the standard contribution. Let's see the standard contribution. Selling price 56, variable overhead 24, overhead absorbs 12. Now they are asking sales volume contribution. I have told you need to take standard contribution here. To calculate the standard contribution, you need to take sales price, then you need to take variable cost. You cannot take overhead absorbs. Why? Absorb fixed cost is not part of the variable cost. Therefore, to calculate the contribution, you cannot take overhead absorbs cost. Is that clear? Therefore, you will take selling price and variable cost. What is absorb overhead? Absorb overhead means general overhead has been allocated among the products using some specific methods. That is not a direct cost incurred for this product. Therefore, you will take selling price and variable cost 56 minus 24. Therefore, this will be multiplied by 56 minus 24. Let's see the answer now. This is equal 200 units multiplied by 32. That is 6,400 unfavorable. Here 6,400 adverse, unfavorable or adverse, right? Here 6,400 unfavorable or adverse variance. We can say adverse variance or we can say unfavorable variance. Answer is 6,400 units. Very important point, when you calculate contribution, contribution is selling price is, you need to take its standard figures. You clearly know that you need to take its standard contribution here, right? Now when you get in the standard contribution, you need to take standard selling price minus standard direct cost. Standard direct cost, that's why we have taken only 24. We cannot take 12 because 12 was absorb cost. Absorption costing technique will use to absorb indirect cost among the productions. Can you remember in the absorption costing what we are going to do? We will take all indirect cost, that is overhead cost, right? First you have to collect those costs, then you have to allocate those costs among cost centers, right? Then you have some indirect cost which cannot be allocated with cost centers, then you will apportion those indirect cost among cost centers using some scientific method. Thereafter, some cost centers not producing units such as service sector, therefore you have to reapportion that service sector indirect cost among the production centers. Thereafter, total production center indirect cost will be absorbed using absorption rate such as labor hours, machine hours or direct material cost likewise or the number of units. That is the cost absorption technique. That's why that absorbed cost cannot be taken as a direct cost. I think you got an idea about the calculation of sale variances. Keep your mind, sales variances divided into sales price variance and sales volume contribution variance. Here you will take the difference between the actual price and standard price into the actual quantity. Here you will take difference between actual quantity and standard quantity into the standard contribution. See this wording, you need to multiply it by contribution. That's why it's called sales volume. Within this bracket you can see the sales volume variance into the contribution, that is standard contribution. That's why it's called sale volume contribution variance. Is that clear? Right. Then can you remember I told you there's a easy method to keep everything in our mind, especially in variance calculation, right? In this level we have basic variances to calculate. Therefore, we can easily keep the variances in our mind. We know when we calculating variance, the basic variance is the profit variance. Main variance is the profit variance. Right? Now I will explain that part. Main variance is the profit variance. The profit will vary. Why profit will vary? Since sales revenue and cost varying. Since the sales revenue and cost varying, the profit will vary, right? Then what are the cost categories? We have few cost categories. Number one, direct material cost can be vary. Then direct labor cost can be vary. Then variable overhead can be vary. And finally fixed cost can be vary. Therefore, we have to calculate the variances of sales revenue, direct material cost, direct labor cost, variable overhead and fixed cost. Other than fixed cost. Why? Fixed cost is very special area. Why? Because fixed cost generally set on the entity's capacity. Set on entity's capacity. Therefore, fixed cost variances should be calculated based on the capacity. However, these four variances, right, that is sale variance and sales variance and these three, sales variance and these three can be calculated easily using special technique, that is quantity and value. Quantity and value. I will color this in yellow because all these four variances calculate using quantity and value. Now, when it's come to sale, value is price variance, quantity is volume contribution variance. When it's come to the direct material, value is material price variance, quantity is volume variance. When it's come to the direct labor, the value is the rate variance, volume is efficiency variance, right? When it's come to the overhead, again you can say value is rate variance, volume is the efficiency variance. Now I will give you this chart using the whiteboard. Right, as I told you, profit variance arise due to the variances arise on sales revenue and cost variances. Profit variance arise due to cost variances and sales revenue variances, right? When it's come to the cost, cost consists four categories mainly, that is direct material cost. Therefore, there may be a variance in direct material cost, then direct labor cost variance, variable overhead variance and fixed cost variance. However, this fixed cost need to be considered separately. Why? Because fixed cost depend on capacity of the business. Therefore, fixed cost variances will be calculated using the capacity and fixed cost absorption rates. Let's discuss separately. However, for both, not both, all sales variance, direct material variance, direct labor variance and variable overhead variances, all four variances have a common characteristics. What is it? All these four, other than fixed cost, all these four items will change according to the quantity. Sales will change according to the quantity, actual quantity. Material, labor and overhead, direct expenses will change according to the quantity. Therefore, all these variances can be calculated, basically basic variances can be calculated using their price and quantity. Their price and quantity. Their price and quantity. Their price and quantity. However, we have different technical wordings to calculate this. Sales price variance, directly we are telling sales price variance, but quantity we call sales volume. Quantity mentioned as volume and multiplied it by the standard contribution. However, finally we calculate price and volume variance, price and quantity. When it's come to the direct material, price take as material price variance, right? That is same price variance. When it's come to the quantity, it's called volume variance, right? When it's come to the labor, price called as a rate variance, that's called rate variance, but quantity, that is volume, in other words quantity, called efficiency variance. Now again quantity is hours, right? Here quantity is hours, therefore it's called efficiency. When it's come to the overhead, again price will take as rate. Generally overhead consider on hours, quantity consider on hours, therefore it take at efficiency, right? Therefore, all these variances based on same technique. Here you will take, since this is revenue, you will take actual first, standard price, actual price minus standard price into actual quantity. Here quantity, therefore actual quantity minus standard quantity into standard contribution. When it's come to again price, now this is cost, better to have lower actual cost, therefore you will start from the standard price minus actual price into actual quantity. When it's come to the quantity, better to have standard quantity first, since it is a cost, standard quantity minus actual quantity, right, into standard price. Again here price, standard rate minus actual rate into standard hours. Volume, you will take the volume variance as we discuss here. The same technique you can use for these variances. Keep this technique in your mind. Basically all for these variances you are using the same technique, the price and quantity variance, but different technical wordings we are using. Okay, let's move into the paper again. We have completed question number 8. Now moving into question number 9. It is about control, that is about budgeting and control. What is the, how it correctly define feedback and feed forward control. It is very simple thing. Feedback means when something happen you are trying to control. Feed forward means when something, before something happened, before that happening you are trying to control it. Therefore feedback control is a control take after the incident. The feed forward control is a control take before the incident. I will give you a simple example, very relative example now. Now, as a country all over the world, we need to control the coronavirus, right? We have to control it. Now, country can do basically two things. They can close all the ports, airports and there are other ports they can close before virus coming into the country, or they can close after the virus entered into the country. See what is the best. In the virus perspective, better to close all ports before virus enter into the country. However, all the countries in the world close their ports after they find out their first patient. That's why all countries, within the countries, this virus spreading. Take an example, a country which is not exposed to the world. They are not exposed to the virus. Why? There is no port. All the countries having international ports exposed to the virus, since they have closed all their ports after entering that virus into the country. Therefore, we had to take that decision before we find our first patient. If so, no patient within the country. But as a country open to the global economy, they cannot close ports. However, when you do something before happening it, it is feed forward. When you do something after happening it, it is feedback. Therefore, answer, feedback control is a reactive measure once it's happening. Feed forward control is proactive, before it happening, proactive measure. Therefore, answer is B. Right. Let's moving into the question number 10. Nimex company uses economic order quantity. This is about inventory. Economic order quantity for their inventory management. Annual demand for raw material, that is D. Summarize information given, right? While you read the question, you need to summarize the information given in the question. Right, now according to this information, I am trying to summarize everything here. D, how much? 95,000. Then what are the other information given? Demand is evenly distributed throughout the year. The cost of placing an order, 12. Cost of placing an order, CO, 12. Then the cost of holding a unit, 3, that is CH, 3 rupees. Yeah. Now they are asking how many orders should company place per year? How many orders should company place per year? Number of orders will depend based on how much you order per once, at once, right? You know, you have, now you need to calculate number of orders, that's depend on total demand divided by EOQ. What is EOQ? Quantity you order at once. This is the total demand. Therefore, once you divide your total demand by EOQ, you can have the number of orders. Therefore, you already know how much the number of orders, demand, that is 95,000. Now, you need to calculate your EOQ. You don't know EOQ. Therefore, let's calculate our EOQ. Our EOQ equal the square root of 2DCO divided by CH, right? Using the calculator, let's calculate our EOQ. Use your calculators and find it. 2DCO divided by CH, right? The square root of the answer 2 into 95,000 into CO, that is 12 divide by 3, then square root of that. Therefore, our EOQ will be 871.8, 871 say 0.8 rounded figure. Therefore, you can replace here 871.8. Now let's see the number of orders. That will be 95,000 divided by 871.8. Approximately 809, right? 109, sorry. Approximately 109, because 108.97. You cannot order 0.97 orders. You have to order a rounded number. Therefore, answer would be 109. Once it rounded, it would be 109. Let's see the answer now. Number of orders 109. I think you can see the answer 109. Right. Moving into the question number 11. The economic order quantity is the order quantity which is result. What is economic order quantity? Economic order quantity will be set when the both considerable cost of the inventory, that is ordering cost and holding cost, reducing. When the both will reduce, that is the economic order quantity. I will explain on the whiteboard. Let's see a quick explanation about this inventory cost. Right. Total inventory cost. Total inventory cost consists 4 items. How inventory coming into the business? First, you need to order. Therefore, order cost. Total order cost per annum. Then you need to buy it. Total purchase cost per annum. Then you need to keep it in your warehouse. Total holding cost. And additionally, you have a specific cost, that is shortage cost. Shortage cost means cost arise, implicit cost, mainly implicit cost arise if there is a shortage over stocks in the stores. These are the 4 stocks expenses during the year. Basically, total ordering cost can be calculated number of orders into cost of an order. Number of orders into cost of an order. This is total ordering cost per annum. Number of orders into cost of an order, that is D divided by EOQ OQ, right? EOQ OQ, number of orders. EOQ O, say Q, right? Into CO. Therefore, simply I can say D divided by Q into CO is the total ordering cost. Clear? Purchase cost. Purchase cost is price per unit into total quantity. Total quantity is the demand. Therefore, finally you can say price into demand is the purchase cost. Holding cost is average inventory, because every day you don't have full inventory and every day you don't have zero inventory, because inventory level gradually decrease and again increase with the purchase, again gradually decrease, because you know inventory move like this, again increase, again you will use, again increase with the EOQ, again decrease. Therefore, per day you have the average inventory at the stores. Therefore, we will take average inventory to calculate the holding cost. Therefore, average level into CO. How you can calculate? You will divide Q by 2, then multiply it by CH. This is the holding cost. Shortage cost, actually we cannot quantify. We cannot quantify. We can't quantify since it's include more implicit cost. Loss of customers, loss of the market share, losing the goodwill, everything is shortage cost. Therefore, it cannot be quantified. And this also very specific. Purchase cost cannot control if there is no discount. If no discounts, then cannot control. Therefore, to handle the inventory cost, you have to control only holding cost and ordering cost. That is the main principle. But if you have discounts, bulk discounts, you can control your purchase cost. Otherwise, you can't, right? Therefore, assume there is no discounts, then to control the total inventory cost, you have to control your ordering cost and holding cost. Now, let's filter that's 2 only. Right. Once we filter that's 2, this is the ordering cost. How you can calculate ordering cost? D divided by Q into CO. How you can calculate this? Q divided by 2 into CH. Let's take to a graph, right? Here cost, here quantity, the amount you purchase at once, right? Look this formula, right? Example, our requirement 95,000 per month. We will purchase 9,500 units at once. Say our cost of an order is 12 rupees as in the question given. Now, how many orders you have to make? You have to take 10 orders. Therefore, cost will be 120. When you order 9,500 units at once, your cost will be 120. Let's take cost 120. Quantity when 9,500. When quantity 9,500, cost will be 120. Can you see that? Let's take another example. For demand 9,500, you will order, right? You will order, let's take, you will double this quantity, 19,000. You will order 19,000. You will double the quantity. When you order 19,000, the number of orders will reduce. Why? At once you will order more. Then your number of orders will be 5. Let's see, 9,500 divided by 19,000. Your number of orders will be 5, right? Number of orders will be 5. Then 5 into 12, total cost will be 60. Now see, when the quantity increase into 19,000 you purchase at once, your cost decrease into 60. Therefore, ordering cost behave like this. Can you see? When the quantity increase, ordering cost will decrease because number of orders will decrease. But when it's come to the holding cost, you are going to order two options, 9,500 units and 19,000 units. When you order 9,500 units, you need to keep maximum 9,500 units in the stores. However, when you order 19,000 units, you need to keep more units within the stores. Therefore, when quantity increasing, holding cost will increase, because when Q increasing, answer will increase. Therefore, your holding cost increase like this. Now, you can see the behavior of cost, both cost, right? Behavior of both cost. Holding cost increase according to the quantity you order. Ordering cost decrease according to the quantity you order. Right. Therefore, to reduce holding cost, you need to reduce the quantity. When you reduce the quantity, cost will, when you reduce the quantity, holding cost will reduce. See. But when you reduce the quantity, ordering cost will increase. Therefore, these two costs are in the both side of a balance. When you try to reduce one, other will increase. When you try to reduce that, this will increase. Right. Therefore, best option is to have this point. This is the best option. This called EOQ. The amount should be ordered at once to minimize both costs. Now let's see the question. The economic order quantity is the order quantity which result in the lowest of the ordering inventory. No, you cannot lowest the ordering inventory. Why? Then holding cost will increase. The highest discount from supplier. No, the lowest combined total cost of ordering and holding. Yes, lowest combined, because you will take the combined point of the cost as I explained on the graph. Therefore, answer will be C. Now let's take question 12. It is about project appraisal. You know, question number 12. Which of the following statement does not describe difference between net present value and internal rate of return? Before moving to the answer, let's see what is NPV and what is IRR. NPV, trying to find out the net cash flow in the present value perspective, right? You know, in a project is an activity going more than 1 year, right? Let's say 5 years. During this 5-year period from today, you will incur different cost, the relevant cost, and you will generate revenue. Therefore, from today up to the end of the project, you can find out net cash flows, right? Those net cash flows, once it's discounted by the project cost of capital, you will have net present value of the cash flow. Therefore, net present value provides you the net cash flow you can be generate, right, in the point of present value perspective. When it's come to the IRR, IRR is a rate, is a percentage, right? IRR gives you what would be the maximum cost of capital to maintain your project in a profitable manner. Therefore, IRR is the rate which gives you 0 NPV. Therefore, IRR is a discounting factor. NPV will become plus, right? NPV will become plus at a specific discount rate. NPV becomes 0 at IRR. Therefore, IRR shows you the break-even point cost of capital. Now, let us see what is the statement does not describe the difference of NPV and IRR. What is the irrelevant statement? NPV result in a rupee return. Yes, the present value of the rupee return. While IRR result in the percentage return. Here, it's a rate. That's correct. Let's see other two incorrect answers. The NPV focuses on project surplus. Yes, NPV give you additional present value you will be earned. While IRR focus break even cash flow level of the project. Yes, IRR gives you the discount factor which gives 0 NPV. 0 NPV is the break even point. You can decide to continue or discontinue the project. NPV assume cash inflows are reinvested at cost of capital. Yes, if project will reinvest the retained earnings every year, NPV assume it will be reinvested at cost of capital. However, IRR assume it will be reinvested at break-even rate, that is IRR. Therefore, answer they have marked as B. A project is accepted when NPV and IRR are positive. No. Under the NPV technique, project will accept when NPV 0 or above. That is, when NPV 0 or positive, project will accept. But when it comes to the IRR, project will accept the cost of capital of the project less than the IRR. Why? IRR gives you the discounting factor which gives 0 NPV. As a rational investor, you need plus NPV. Therefore, you will select a project which has cost of capital less than IRR, because when you have the rate less than IRR, you have a positive NPV. When you have project cost of capital more than IRR, you have negative NPV. Therefore, when your project cost of capital reduce than IRR, you will accept the project. Clear? Therefore, answer is B, because answer B is incorrect when describing the difference between NPV and IRR. Now, moving into question number 13. Rent expense on the factory building 100,000 is allocated to 3 departments. Rent is a indirect cost. It is manufacturing overhead, factory building rent. It is not a direct cost, can be directly identified with the product. Therefore, you have to absorb it, you have to apportion it. Now, this factory has 3 departments. The cost allocation based on the square feet, which equal 40,000 square feet with the building, right? Therefore, 100,000 rental available for 40,000 square feet, right? 100,000 rental applicable for 40,000 square feet. Therefore, per square feet you pay 2.5, that is 2 and 50 cents. 100,000 rental paid for 40,000 square feet. Therefore, cost per square feet 2.5. You have 3 departments A, B, C. These are the square feet. Therefore, this should be multiplied by, that is 15,000 should be multiplied by 2.5 cost per square feet, that is 37,500, right? Then for the, this is for A, right? This is for A. Then for B, 5,000 square feet multiplied by 2.5, that will be 12,500. Then for C, 20,000 square feet multiplied by 2.5 per square feet, that is 50,000. Therefore, answer would be 37,500, 12,500 and 50,000. That is answer B. That is the apportionment of indirect cost among 3 cost centers. Right? That is question 13 regarding overhead cost apportionment. Okay, let's take the question number 14 now. The following monthly sales information are given for January to May of a year. January, February, March, April, May. Sales figures given 23 million, 32 million, 40 million, 23 million and 36 million. This is a mathematical question, mathematics, right? Here they are asking what is the mean, what is the medium and what is the mode, right? Let's take these 3 numbers. Let's take these 3 numbers into the Excel sheet, then we can easily calculate everything on the Excel sheet. Let's take the figures here: 23, 32, 40, 23 and 36, right? For the 3 months, these are the figures. For the 5 months, these are the figures. The number 1, they are asking mean. Mean is the average. Therefore, we can calculate mean as the average. Take the total first. Let's take the total 154. Then take the average. This is total. Therefore, average equal 154 divided by 5. We have 5 numbers there. 1, 2 here. 1, 2, 3, 4, 5. Therefore, n equal 5. Therefore, divide by 5. Therefore, average mean value 30.8. Now, let's move into the answer. We have 30.8, 2 answers here, A and B, right? Therefore, you have to find out medium as well as mode. At least if you can find out the medium, then no need to go for the mode, because now you are in these both answers, right? But once you, in this case, median is different in these 2 answers, 40 and 32. If you can find out medium, easily you can find like the answer. Okay, let's see. What is the median? Median is, you need to write down these numbers into ascending or descending order. Then find the number at the middle. Let's take it. Lowest number 23. Again, there is another lowest number, that is 23. Then the lowest is 32. Thereafter 36. And finally, highest number 40. Now, median is the middle number. This is the middle number 32. Therefore, you can take median as 32. Therefore, answer would be B, not A, right? Answer would be B. Now, what is mode? Mode is the number many times reported within the data series. Now, here 23 reported 2 times, all other numbers reported only 1 time. Therefore, mode is 23. Answer will take as B. Let's moving into the question number 15 now. Question number 15 relating to 2 questions, right? Forecasted contribution of 2 projects are given below under the 3 economic conditions. Actually, this is a question about decision rules, right? This is a question about decision theory and decision rules. Let's take this question. Forecasted contribution of two projects are given below under three economic conditions. Three economic conditions are optimistic, most likely and pessimistic. Project A, optimistic 45,000, most likely 40,000, pessimistic 25,000. Project B, 53,000, 38,000 and 15,000 respectively. They have been given the probabilities of each project under three economic conditions. Optimistic, the probability is 30%, most likely probability is 50% and pessimistic probability is 2%. What are the expected total contribution of project A and B? What is expected contribution? Let's take project A. The expected contribution of project A, that is, you will take all three possible profits. Those are 45,000, 40,000 and 25,000. Then you will multiply it by relevant probabilities of each. These are possible, right? These are possible outcomes. Then you will multiply it by the probability. Probability given as 30%, that is 0.3, then 50%, that is 0.5, right? Then finally 0.2. Once you multiplied each figure by the probability, you can have the expected value. This is possible value. When possible value multiplied by the respective probabilities, you can have expected value. Therefore, here I can say this is possible value, right? Then this is probability. Therefore, finally you will end it with expected value, right? Therefore, let's see the expected value here. 30% into 45,000, that is 13,500. Here 13,500. When it's come to here 20,000. %20 is 5,000. Therefore, total will be, the total of these three will be 23,000, 33,500 plus 5,000, 38,500, right? Therefore, project A, you can say the 38,500. Here you have three answers as 38,500. Therefore, you require to calculate the B also. When it's come to B, you need to multiply this by 20%, this by 50%, this by 2%, right? Here the 30% on this will be 15,900. Then 50% of this will be 19,000. The 20% of this will be 3,000. Therefore, sum of this expected value of all these three possible value will be 37,900. Therefore, answer will be C. When you ask to calculate the expected value, take possible values, then find out the probability for each possible value, then multiplied possible value by percentage, the probability. When the possible value multiplied by the probability, right, you have the expected value, right? Then question 16 relating to that question. If there is a fixed overhead cost of 5,000, as a risk averse investor, this is very important, right? As a risk averse investor, which project would you prefer and why? As a risk averse investor, In decision rules, there are three techniques of getting decisions. I will take that point, right? In decision rules, there are three techniques of getting decisions, right? That is chapter, this is the chapter. Chapter 14, under the chapter 14 you have a topic called decision rules. This is the topic, decisions rules, under chapter 14. Now that question was raised based on chapter 14, subchapter 9, decision rules. Under the decision rules, we have three techniques of getting decisions. What is this decision rule? Actually, in the world, when we are getting decisions, some decisions can be taken assigning probabilities, as well as some decisions cannot be taken assign probabilities. When you have an incident, when you can't assign probability, in such a case, your decisions come under decision rule. Is that clear? In the world, when you are taking decisions, some decisions can be taken under assigning the probabilities, as well as some decisions can be taken without assigning probabilities, because you can find out the probability. When you can't find out the probability, you can't go for the expected value. In that situation, you have to take your decision using decision rules. If you can assign probabilities, you can use decision tree, because you know in the decision tree you can assign probability. If you cannot assign probability, you will use decision rule. That is the basic classification. I will repeat it. In the world, when you are making decisions, in the future decision will be uncertain and risky, right? For some future situations, you can assign probability and calculate expected value. Technically, this can be done through decision trees, because in decision trees we are assigning probabilities for each branch. But in some scenario, you cannot assign expected value. You cannot assign probability for future events. When you can't assign probability value, you have to use decision rules instead of decision tree. Now we are going to learn how decision rules can be used. Is that clear? Okay. When you apply decision rules, there are three methods of getting decisions. The first method is maxi-min decision rule. Maxi-min decision rule. Then maximize decision rule and minimax regret rule. These are the three rules you need to keep your mind. I will take whiteboard to explain this part. Why I need to explain to you? This is a new lesson included into the management accounting paper when compared into the previous syllabus KE2 subject. Therefore, we have to learn this with detailed information. Right. When we take decisions, when taking decisions, right, those can be divided into two. Decisions can be taken assigning probabilities. That means you can calculate expected value as we calculate in the previous question. example, you can use decision tree technique, because you know in the decision trees we are assigning probabilities. For some decisions cannot assign probability. When you cannot assign probability, you cannot calculate expected value. In that time, you will use decision rule, right? In such case, you will use decision rule. In decision rule, you are not going to assign probability. These decision rules, we have 3 decision rules. 1, maxi-min. Second, maximize, and minimax regret rule. The third point, as explained, it is minimax regret rule. These are 3 techniques of getting decisions where you can't assign probabilities. Where you can't assign probabilities, you will use decision rules. You have 3 decision rules. Let's see what are these decision rules. What is maxi-min? Right? I will take the study text to explain maxi-min. Okay, let's take this example. Now we have 3 projects, D, E and F. We have 3 projects, D, E and F. We have to select one project. Not only that, we have 3 economic conditions, say pessimistic, most likely and optimistic. We have 3 economic conditions. All these 3 projects will give different net profits under 3 economic scenario. Now if you select project D, in the best economic scenario you can earn 100, average economic scenario you can earn 90, worst economic scenario you will have a loss of 20. If you select project E, the best economic scenario, the economic scenario 1, we can say that is best. Economic scenario 1 give you 80 profit, economic scenario 2 you will receive 120, and economic scenario 3 you will receive 10. Likewise, F also has 3 different profits under the 3 economic scenario. Now our question, which project I select? Now this cannot be assigned probabilities. You don't have given probability under each economic scenario. If you have probability under each economic scenario, you will multiply each number by the percentage and you will take the expected value. Now here you can't take expected value since there is no probability under 3 scenario. In such a situation, how we can select the best project? Is that clear? How we can select the best project? Now here they have explained how you can select the best project using maxi-min rule. Maxi-min. Look at the word maxi-min. Maxi-min. That means you will take 3 projects, D, E and F. If you select 3 projects under the worst situation, you have a loss of minus 20. You have a loss of minus 20. This is the worst scenario under D, minus 20. If you select E, the worst scenario will be 10, the lowest one. If you select project F, lowest scenario will be 60 because that is the lowest. Clear? In the project D, minimum profit will be minus 20. Project E, minimum profit will be 10, project F, minimum profit will be 60. That means you select minimum of each project. Then out of, now you have 3 minimum. Out of this 3 minimum, you will select highest. That's why it's called maxi min. You will select maximum out of minimum. You will select maximum out of minimum. Now what are the minimum? 20 is minimum for D, 10 is minimum for E, 60 is minimum for F. 20, 10, 60. Right? 20, 10, 60. 3 minimum numbers. Maximum out of minimum. Therefore, you will select maximum out of minimum. This is the minimum 3 numbers. 60, 10 and 20, or minus 20, 10 and 60. Out of 3 minimum numbers, maximum number is 60. Therefore, you will select project F. That is the maximum theory. According to maximum theory, I will explain it on the whiteboard also. Then you can have a proper idea on that. Let's take that example into the board. You have 3 economic scenario 1, 2 and 3. You have 3 project D, E and F. Right? Figures, profit 100, 90 and minus 20, 80, 120 and 10, 60, 80 and 80. Now, our rule is number 1, maximin. Look at the wording, maximum out of minimum. Maximin, maximum out of minimum. Let's round. This is the minimum of D, this is the minimum of E, this is the minimum of F. We have to select a project. 3 projects, these are the minimum numbers. Maximum out of minimum is this. Therefore, according to maximin, you will select project F. Clear? Right. Now let's take the second technique. The second technique is maximize technique. Maximax or maximize. Maximax or maximize. You will select highest of each project. Here you have select lowest of each project. Now you will select highest of each project. What is the highest here? 100. What is the highest of E? 120. What is the highest of F? 80. Both highest. Now you have selected maximum in each project. Now you have to select maximum out of maximum. Maximum out of maximum. Therefore, what is the maximum out of selected maximum? This is. Therefore, you will select project E. Right? You will select project E, maximum out of maximum. Then, let's say the third method. The third technique is a little bit different technique. Minimax regret rule. What is regret? Actually, regret is the opportunity cost. This is the opportunity cost, right? Maximum opportunity cost you need to select. You will select maximum opportunity cost, then out of maximum opportunity cost you will select the minimum. Got it? You will select maximum opportunity cost of each project. Maximum opportunity cost of each project, then out of that maximum opportunity cost you will select the minimum. Let's see. You have 3 scenarios, 1, 2, 3. 3 project D, E, F. Let's assume you have selected this project. Then you won't be able to select E or F, right? If you select D, you can't select E or F. However, if you select project D under first scenario, this is the highest profit, clear? This is the highest profit, therefore no opportunity cost. But if you select E, you can have earn only 80, but you will lose opportunity to earn 100. Got it? If you select E instead of D, you will earn only 80, then you can't earn 100. Therefore, you have opportunity cost of 20. You will lose additional 20, ability to earn 20. But if you select project F instead of D and E, you would have earned 80 or 100. 2 opportunities you have. But opportunity cost always consider the highest foregone opportunity. Highest foregone opportunity is 100. Since you have selected F, you earn 60, but highest opportunity is 100. That means you will lose 40. No need to consider this, because when you are standing here, the opportunity cost is this, not this, because opportunity cost consider highest foregone alternative. Highest foregone alternative is this when you are standing here. Therefore, your opportunity cost is 40. When you are standing here, right, the highest foregone opportunity is 100, therefore loss is 20, difference. When you are standing here, you don't have opportunity cost because that was the highest. Okay, now let's take the second scenario. Assuming the second scenario, you have selected 90, then highest opportunity foregone is 120, therefore you will lose 30. But if you select this, no opportunity cost. If you select this, you have opportunity cost, that is 40, right? When you select this, and if you are here, right, if you are here, you have a loss of 20, you will lose the highest opportunity of to earn 80. Then how much you will lose? You can have eliminate this loss and earn 80 if you select if instead of D. Therefore, if you are standing here, what happened? How much the opportunity cost? The difference between these two, that is 100, right? If you select here, you will lose this opportunity, that means you will lose 70. If you select this, you don't have opportunity cost, then it is 0. Now you calculate regret. Now select maximum regret. This is not the total, you will select maximum regret of each project. The maximum regret is each project, here 100, here 70, because this is the maximum, here 40, right? Therefore, now you calculate regret, you find out maximum regret of each project, then you will select minimum out of these 3. Therefore, this is the project you must select. Therefore, according to maximum regret rule, you have to select project F. I think you got the idea, right? You have to select project F. Now, you have to understand in which scenario you can use this technique. Here, you will find out losses you can earn. Out of that, you will select the maximum. Losses you will select, then out of you will select the maximum. That is, here you will find out the worst scenario. You will find out the worst scenario. Here you are trying to find out the best scenarios. Here you are going to find out the opportunity cost. Generally, when you think always worst scenario, that is called negative thinking. When you think about the best scenario always, that is called positive thinking. In the investor perspective, worst scenario, that is risk averse investors. Person who doesn't like to accept risk, they always think negatively. When people not accept risk, they think negatively. They always think about the worst scenario. But when people accept risk, when they are the risk lovers, when they are like to take risk, we call risk lovers. They are like to take risk and do works. They always think about the best scenario, the positive thinking, right? The positive thinking people, risk lovers, always worst scenario thinking people are risk averse. Now let's take the question. See question number 16. Now these are the two projects, right? Here project A, project B, right? Now project A and B has three economic conditions. Now our previous example we had three projects. Now here we have two projects. We have three economic conditions, right? Now they ask if there is a fixed overhead cost 5,000, that fixed overhead cost is applicable for everywhere. Therefore, it is not a matter to consider, because if you consider fixed overhead cost, always 5,000 is everywhere, right? As a risk averse investor. Who is risk averse investor? Person who not like to take risk. Then person who not like to take risk always consider the negative thinking or the positive thinking. He takes the negative thinking. He always seeks the lowest profit can be a rise. The lowest profit can be a rise. Then out of lowest profit, he will select highest, because our technique is maximum rule. You will select minimum, then out of minimum you will select the highest. Out of minimum you will select highest. That is the risk averse investor. Now in the project B, lowest profit is 15,000. Project A, lowest profit is 25,000. Then you have selected minimum, then maximum. Out of minimum you will select maximum, that is 25,000, right? This will be the selection, right? This will be the selection, 25,000. But you have to select in wording the risk averse investor. Which project would you prefer and why? Highest total expected value. No, he never expected highest profit. And here we are not talking about expected values. Then let's see answer. See, highest total expected value. Highest total expected value of project B. No, he not always think about expected values, and he is not select always highest values. Then answer D, project B, highest forecasted profit at optimistic condition, right? He is risk averse, doesn't like to take risk, therefore select lowest profit, right? Lowest profit of B 15,000, lowest profit of A 25,000. Then they will use maximum rule, that is select minimum, then select highest out of minimum. You know highest out of minimum is 25,000. He will select project A under the pessimistic. Project A under the pessimistic. Here he will select project A, highest forecasted profit at pessimistic condition. Here highest forecasted profit at pessimistic condition. Therefore, simply you can say risk averse use maxi-min rule, risk lover use maxi-max rule. Therefore, if examiner asks what is maxi-max rule, right, you have to select highest answers and highest out of highest. If examiner asks maxi-min rule, you have to select lowest answers, then select highest out of lowest, as we did here, right. Sometimes examiner will ask what is the decision taken by risk averse investor and risk lover investor. Always keep your mind, risk averse always use maxi-min, risk lover always use maxi-max. That is the theoretical background behind this question. Then we will move into the question 17 and 18, right. Now again you have 2 units condition, producing 30 units and producing 70 units. However, in these 2 scenario, say this is 2 projects, 30 units project or 70 unit projects, then they have given high demand condition and low demand condition, right. But fortunately here they have given percentage, the probability of each condition. Since they have given the probability of each condition, no need to use decision rule, you can use decision tree. Can you remember, as I told you, decisions can be divided into 2. Decision will be taken with expected value with the probability, and decision cannot be taken with expected value, that is there is no probability. Now this is with the probability, therefore you can use decision tree. Now the question, company uses a decision tree to support their decision on what quantity is produced, right. Now here they can use decision tree. Why? They have given the probability. What is the quantity to produce and expected profit? Let's put them into the decision tree. Do these 2 projects, if I take the information, you can produce 30 units or you can produce 70 units, right. You have 2 economic condition, high demand and low demand. The high demand probability is 60%, low demand therefore would be 40%. Profits given under the 30 units 5,000 and 3,000. 5,000 and 3,000. Under the 70 units 12,000 and low demand minus 7,000. That's a loss. Now the previous type of question, you have like 2 projects and 2 economic condition, but you have the probability. Can you see that? You have the probability, right. Therefore, no need to go for the maxi-min or maxi-max or mini-max regret rule. No need to use decision rule, we can use decision tree because we have probabilities. If you use these figures, what you have to do? You have to multiply it by the probability. You have to multiply it by the probability. If you multiply it and rewrite it again, 30 units, 70 units, right, high demand and low demand, if you multiply it by the probability and rewrite it again, see 60% into 5,000, 3,000 is the value. 40% into 3,000, 1,200. Therefore, total 4,200. Here 60% into 12,000 will be 7,200. Then 40% into 7,000 will be 2,800, but it is minus. Therefore, total expected value. Now, these are expected values, right? When you have expected value, you need to take the total to have the 100%. Here, to have the 100%, you need to take the total value, right? Because here you have 60%, you have 40%. To take the decision, it should be 100%. Therefore, you need to take the total. Now, here total will be 4,400, right? Now, which you select? You need the highest profit. Therefore, this is the highest profit. You will select this. Therefore, what is the quantity? 70. Therefore, answer would be quantity 70, profit would be 4,400. Here you can see the answer. Quantity 70, right? Quantity 70 and profit will be 4,400. Is that clear? Quantity 70. I think you can go back to the video and see my calculation on the whiteboard. Quantity would be 70, highest profit will be 4,400. Rational investor always select the highest profit. Now let's see the second question. Question 18. Which expected profit or loss figure would encourage a risk-averse decision maker? Who is this risk-averse decision maker? He is the person doesn't like to take risk, right? He is not a lover. He want to eliminate the risk. He want not to accept the risk. Decision maker to change his or her decision. Now, if you use the table I have given on whiteboard, right? I have given on whiteboard expected profit table for 30 units category. This risk averse person 30 units category, the lowest profit will be 1,200. If we not consider the probability, lowest profit will be 1,200. Under the 70 units category, the lowest profit is minus 2,800. Now, risk averse investor, right? Risk averse investor would encourage a risk averse investor, decision maker, to change his decision. He will change his decision at the lowest. Therefore, under 70 units, that is 2,800, under 30 units 1,200. Therefore, risk averse will select 1,200. Therefore, he will encourage to change his decision at 2,800. Therefore, you have to select the answer as 2,800 in the question number 18. I will show you the answer here. Not 18, that question number 18, yeah. Answer minus 2,800. Right. Now, we will move into the next question. These next questions consist 5 questions. You can see that 19, 20, 21, 22, 23. You will wonder why. This is a process costing. In my seminar series, focus on this area. I told you, your paper may include a huge process costing question. You have to prepare the process and you have to answer many questions. You have to answer many questions using this process answer. Therefore, what you need to do, answer for these 5 questions. Don't worry, you have 5 questions. One question, how many times available? You have 120 minutes, right? You have 120 minutes because you have only 2 hours. 120 minutes, 400 marks. Therefore, 1 marks, you have 1.2 minutes. Therefore, here 5 questions means 10 marks. Therefore, you can multiply it by 10 marks. That means you have 12 minutes to answer. What you have to do? When you have 5 questions from this type of big case, this is a process account, right? Use these 12 minutes, at least 9-10 minutes to prepare the entire process. However, within 10 minutes you have to prepare the entire process account. Then based on the outcome of the process account, you can easily underline the answers of the 5 questions raised. Now let's see what are the 5 questions raised. The first question they are asking, what is the abnormal quantity, abnormal loss? Then next question they are asking, what is the total cost incurred for fixing process during the period, total cost of the period, that is the debit side total without the work in progress. Then what is the material cost per equivalent unit under weighted average method? They ask you to use weighted average method. Then what is the cost of abnormal loss and gain of fixing process? Then what is the cost of transfer to next process from fixing process? Now they have given us a hint, that is we have to use weighted average method to prepare this process account. Therefore, let's read this and let's prepare the process account. Based on the process account, you can easily answer the question. Right. Kamsi and Kamsi company manufacture this product, their product, through 2 processes, fixing and finishing. At the beginning of the August, fixing process had an opening work in progress 200 unit valued at 8,300 and the break even is as follows. Now they have opening work in progress. Remember, examiner asked us to given a hint to use weighted average method. Now here they have given opening work in progress 200 units, their total value 8,300, right? This is the classification of that cost and the percentage of the opening work in progress. Therefore, we can use a sketch, right? Sketch of process account. Now we can fill in the blanks while we reading. Opening work in progress, quantity 200, value 8,300, right? Then let's see the balance information. During the month August, 1,000 units of material were added to the fixing process, right? Due to the limitation in machine, 10% of material added to the fixing process were expected to become loss with scrap value of 11. That means you have introduced material 1,000 during this month, 10% normal loss, that can be sold at 11 per unit, that is scrap. Therefore, you can say direct material 1,000 units. You don't know what is the value, but you know here to next process. To the next process you will transfer, then you can have normal loss. I will take NL, normal loss. Normal loss is 10%, right? Normal loss, they said 10%, right? Therefore, you can take normal loss 10% on this 1,000 introduced. Therefore, normal loss quantity will be 100. They have given the value. The normal loss value will be 100 into 11. Therefore, normal loss can be sold at 1,100. Right. Again, moving into the question. By the end of August, 940 fixing process completed unit were transferred to the next process. They completed 940 and 100 units remain in closing work in progress. Their percentage of complete is given, right? 940 completed, 100 incompleted. Therefore, you can say 940 transferred to the next process, and you have to find out if there is abnormal loss, right? You have to find out abnormal loss or abnormal gain with the final work in progress. They have given final work in progress as 100 unit, right? Since total 1200 here, you can see total value 1200 according to the debit side. I will take that here. Total 1200. You can take here 1200. Now, I think there is a value, this equal, this minus, all these figures you can easily do with your calculators. Therefore, abnormal loss will be 60 units. Now, can you remember your question? First question, what is the abnormal loss or gain in units? That is 60. We already arrived that answer. Abnormal loss 60 units. Here is the calculation. This is one finding. They ask, what is the abnormal loss? 60 unit. Now, our next duty is to find out the other cost you introduce. Let's take the question. After the percentage of completion in this closing work in progress, they have mentioned cost introduced during the month. Material 22,200. Material 22,200 cost incurred. In addition to that, they have incurred direct labor and other cost. Let's see what are the values. 5,300, 10,800. 5,300 and 10,800. Here 5,300. Here 10,800. Right. Therefore, you can take the total cost here, but that total cost consists the opening cost also, right. Now, what we have to do, we have to distribute this opening cost among the finished good, abnormal loss and work in progress. That is the requirement, right. Okay. Now, let us see the second question raised. Second question raised, they are asking, what is the total cost incurred to fixing process, to this process during the period August? What is the cost incurred only in August, right? This is the total cost incurred including the opening work in progress incurred in the last month, that is July. Therefore, cost incurred only in August is these three highlighted numbers, right? That is 22,200, 5,300 and 10,800. These three values are the cost incurred during this period. The sum of these three only 38,300. Therefore, answer is 38,300. Now, already you answered to two questions, right? Already you answers to two questions, right? Now, next, to answer next questions, you need to find out the values of abnormal loss, finished good, as well as you need to find out the value of material cost per unit. For do this, you need to complete the values of these places. Therefore, you know you need to do three workings. Number one, equivalent unit statement, then cost statement and total cost statement, right. Let's calculate equivalent unit statement first, right. In that case, we need to take under the equivalent unit statement how much you incurred for direct material, how much you incurred for direct labor quantity and how much for other cost. Now, you have open work in progress, current month, finished good. Since you are using the weighted average method, you assume both will be completed together. Then you have to take normal loss, then you have to take abnormal loss and closing work in progress, right? You know, we are no abnormal loss, the quantity wise, total finished good, that is both 940 here, total finished good 940, open you had 200, therefore current month you completed 740, that's how total become 940 here, right? Then normal loss 100, but normal loss you are not consider in the equivalent units, therefore you will take 0 in equivalent unit statement relating to normal loss, because normal loss will be included in the finished good, therefore you are not taking values for the normal loss for direct material, direct labor or other cost. Then abnormal loss 60 units and closing work in progress 100, right? We know opening work in progress and current month both 100% completed, therefore same numbers you can take in the each cost category. Current month also completed 740, you can take 100% as 100% completed. But when it's come to the abnormal loss, we have to assume abnormal loss will be occurred at the end of the process, right? If you assume abnormal loss occurred at the beginning, only material gone loss, labor and other cost 0. But if abnormal loss occurred at the end of the process, all the cost items gone loss. Here we assume abnormal loss occurred at the end, therefore 60, 60 and 60 gone loss in each cost category. But work in progress, closing work in progress, they have mentioned 100% already incurred material, 60% labor, 40% overhead. Therefore, 100 material completed, out of 100, 60% completed labor, that is 60, out of 100, 40% included other overhead, therefore only 40. Now you can easily calculate equivalent units for each cost category. Here taking the total 1100 equivalent units, 1060 equivalent unit and 1040 equivalent units. Now you can take the cost statement, right? You know, you had open work in progress in the, we are using weighted average method, and current month cost you need to take separately, right? They have given direct material, direct labor and other for opening work in progress. Then current month cost also they have given separately. Let's take from the question. These are the current month cost: 22,200, 5,300 and 10,800. Let's take current month cost: 22,200 material, 5,300 labor, 10,800 other conversion cost, right? Then opening cost, they have given the detailed list of each cost category. This is opening work in progress breakdown of the cost: 4,200, 1,000 and 3,100. 4,200, then 1,000 and I think 3,100, yes, 3,100. Now you can take the total here, the total for each cost category. But don't forget, here you have eliminated normal loss from the quantity. Can you see that? You have eliminated normal loss from the quantity, here 0. Therefore, you need to eliminate scrap value of normal loss from here. Scrap value of normal loss you already calculated in the question here 1100. Scrap value of the normal loss you already calculated 1100. Therefore, you need to eliminate that value from here, right? You will eliminate that value from here. That is minus 100, 1100 you have to eliminate. Now, you can calculate again the net value of each cost category, right? Here it will be 25,000, 300, and other two cost categories remain as it is, since no deduction, since labor and other conversion cost. Now, what you can do, you can divide this cost by the number of units to find out cost per unit. Now, let us take cost per unit. What we have to do, we will take total cost, then we will divide by equivalent units. Then here we have 23. Let us take for other situation. Here 5.9, here 13.3. Now, this 5.9 we can round it as 3, or we can use with 5.94, right? Okay. Now, let us see the balance questions. What is the material cost per equivalent unit? Material cost per unit. Material cost per unit, weighted average method. Now, we already calculated material cost per unit. Here is the answer. It is 23. Therefore, your answer will be 23. Right? Next question. What is the cost of abnormal loss? Let us see. The cost of abnormal loss. You know abnormal loss quantity 60 in each category. Material, labor and other overhead. All these cases it is 60. This is material cost. This is labor cost. This is other cost. Therefore, you can take the total here. Right? Let us take total here. Then easily you can multiply by this 60 to have the cost of abnormal loss. Therefore, this is equal 60 in each category. 60 in each category. Therefore, no need to multiply separately. You can multiply it by the total. Therefore, the value of abnormal loss would be this equal 60 multiplied by total cost, right? 60 multiplied by total cost, that is 2539. Let us see the answer, 2539, right? Now, don't do this if you have different values in these three cost categories, right? Now, here we have assumed, in this case we have assumed abnormal loss was occurred at the end of the production process. That is, abnormal loss include all the cost categories of material, labor and overhead, right? Therefore, under each category you can see abnormal loss quantity is 60. Therefore, it is not required to multiply 60 by 23, 60 by 5.9, 60 by 13, because you can take total, since everywhere 60, right? But if this quantity is different due to the loss, the place that loss occurred, right, you have to multiply it separately and take the total, right? Then let us see the final question. What is the cost of unit transferred to the next process? Let us see. Cost of the unit transferred to next process, that is this, right? So, you have to calculate the cost of 940. Therefore, this is equal 940 multiplied by the total cost per unit. Why? again 940 equal each cost category, it is 940. Therefore, you can multiply it by the total. That would be 39,770. Let's see the answer. 39,770. That there is no that answer, but you have approximate answer 39,771. Why? You have 1 rupee change due to the decimal changes. Now you experience how to answer process costing account when it has more questions based on single set of information. Now I think you got the understanding how to answer process costing account. When the process costing questions covering more than 2-3 questions using the same set of information, see what type of question they requested. In this question, they requested the abnormal loss quantity, value of abnormal loss, right? Value of finished good, value of cost incurred during the period. Those are the figures they requested. Therefore, it is covering the entire process accounts, right? In such a situation, when it has more than 10-12 minutes, it is better to prepare the question and using the table answer the question. Easily you can select the 5 answers, right, as we did here. Therefore, better to use this method if questions brings 5 marks and if you have more than 10 minutes, because you know you can do this within 5-6 minutes, then easily you can answer based on your final outcome. I think at the exam they will provide draft sheets to do these calculations, because otherwise you have to calculate those things on the paper itself. You can say, I believe you can ask additional sheets to do these calculations. Therefore, bring your calculators, pen and pencils, and do these calculations if required and answer easily as we did here. Now let's see the question number 24 and 5, because those two questions also going together with the same set of information. A company produced 1000 units of product D during a week. Following costs are related to the production of D. Direct material 12 rupees per kilogram, direct labor 50 rupees per labor hour, direct other expenses 32 rupees per labor hour, right? Not per unit. Per kilogram material 12, per hour labor 50, per hour overhead 32. Overhead cost per week 240,000, which is absorbed to product using machine hours. Total overhead 240,000, which is absorbed to product using machine hours. A unit of product D uses 10 machine hours. Per unit you require 10 machine hours, 3 kilograms of material, 2 labor hours. 100 units remain at the inventory at the end of the week. What is the value of closing inventory if the company uses marginal costing? That means 100 unit of closing inventory should be multiplied by marginal cost per unit. Got it? Marginal cost per unit. Marginal cost means the variable cost. Here direct material, direct labor and direct other expenses are the marginal cost. However, in this 12, that 12 per kilogram should be multiplied by price per kilogram, that is number of kilogram 3, number of kilogram 3, labor hours 2. Therefore, let us calculate 12 into 12 rupees into 3 kilograms, that is material. Then let us take labor. Labor requires 2 hours, 1 hour 50 rupees. Therefore, 50 into 2 hours, that is labor. right? That is labor. Then let's take variable overhead to take the total marginal cost. Now to variable overhead per hour, direct other expenses 32 rupees. Again that's based on labor hours, therefore you will take 2 hours, right? Now let's take the total. Total will be total marginal cost 36 plus 100 plus 64, that is 200. 36 plus 100 plus 64, that is 200. You have the total is 200, right? Now you have 100 units, clear? You have 100 units in the closing inventory. Marginal cost per unit is 200. Therefore, cost of the closing inventory will be rupees 20,000, right? You can see the answer. It is 20,000. Why? You have to calculate the closing inventory using marginal costing. Marginal costing is direct material, direct labor and direct other. However, this cost category is given not per unit basis. This is given per kilogram. This is given per labor hour. This is also given per labor hours. You require 3 kilograms of material, 2 labor hours and other expenses based on 2 labor hours. Therefore, we have calculated marginal cost per unit as 200. Since you have 100 units, you calculated your closing inventory at marginal cost as 20,000, right? Now, next question 24, you have to calculate here, see, you have to calculate the closing inventory value, right? Closing inventory value, the value of closing inventory if you are using absorption costing method. If you are using absorption costing method, what you have to do, you need to take this variable cost, total marginal cost plus absorb fixed cost, right? You have to take absorb fixed cost. Here in the question they clearly mention, right, how they are going to absorb the fixed cost. The total fixed cost per week, these are the information per week, right? Total fixed cost 240,000, which is absorbed to produce product using machine hours. A unit of product D uses 10 machine hours, right? Now this is the total fixed cost. This is the total fixed cost 240,000. You know total fixed cost will be absorbed based on the capacity. You had the capacity for 1000 units per week. 1 unit require 10 machine hours because you will absorb your fixed cost using machine hours. Therefore, 1000 units will multiply it by 10 machine hours to find out cost, fixed cost per machine hour, right? Fixed cost per machine hour. How much the fixed cost per machine hour? That is 240,000 will be divided, right? 240,000 will be divided by 10,000. Therefore, fixed cost per machine hour will be 24. Fixed cost for machine hour will be 24 rupees. Now what you have to do? You need to calculate fixed cost per unit. Fixed cost per unit, that is 10 machine hours require, right? 10 machine hour require per unit. Therefore, fixed cost per unit will be, here fixed cost ₹20, 24 rupees per unit, but sorry, unit is the machine hour, 24 rupees per machine hour, you require 10 machine hours. Therefore, you require 240 rupees per unit. Now here 240 rupees per unit is the fixed cost, 200 is the marginal cost, totally 440, then into 100 unit will be the value of the material, right? Value of the material at the end of the absorption costing method, right? That is the end of the first 25 questions, right? We will meet the balance 25 question with our next video.